I feel like it's been raining. I feel like it's been raining constantly since like what, Monday? What's today? Wednesday? Recording on Wednesday for this
Yeah,
week.
it has. It feels like it's like getting closer to winter, which is depressing.
I was actually thinking that same thing on the way in. I feel like you start to realize it when you don't have to wear your sunglasses,
Yeah.
like on your drive in the morning is what I was thinking. And I was like, I haven't worn my sunglasses yet this week because it's just been cloudy and gray, which is the
I
Nashville
start to
winter.
realize it when I am getting up in the dark. Oh my
Yeah,
God, that's terrible.
I mean, it's dark till like
Knowing you have to
6:30
get
right
up.
now.
I
I like
know.
this bit of fall during October, and then obviously November hits, and you've got Thanksgiving and the holidays and everything. So I don't mind this season, just because it's been so hot, and then you have the season of cool weather, and then it's really that like January, February,
The
March that I
calm
don't
before the
necessarily.
storm
Yeah,
of
Yeah, I
everything
mean
is
the cooler weather is
um,
nice. Like I feel like
starting.
it was like so hot July and August that, and even September really, that these cooler mornings we're having have been nice. But you want like the nice sunny, crisp, cool mornings, and we're getting, I feel like,
Mhm.
kind of like cool, gray, cloudy, rainy, cool mornings.
I know. My birthday was on Monday, and I got up. It's not only is it on a Monday, but it was rainy and gross outside. It's like, happy
yeah,
birthday.
yeah. So well, welcome back to the Retire While You Work podcast. Thanks for joining us. I know I was out last week for my daughter's fall break, celebrating her 7th birthday down at the beach, and getting back into the swing of things today. I feel like the biggest headline and what's kind of happening, and also feel like it's a conversation we've been having constantly over the past like 2 or 3 years, is the Fed and cutting interest rates. It's just been the constant discussion of interest rate cuts, mortgages, when are interest rates finally going to come back down for those that have debt, especially variable debt. So it's kind of the main topic of discussion in a lot of facets of economic and market discussions. But I think even for us, and kind of what I think is a good topic for us, is what all that impacts, because it impacts both savers and borrowers, but in different ways.
And I think it impacts the economy as a whole. I mean, I guess that falls into the borrowers category, but obviously, if debt's a little bit cheaper, businesses are willing to maybe take on some financing options to grow and expand the business. And when debt's expensive, they're maybe kind of just more okay with staying status quo and getting through this period a little bit more lean while they do wait for rates to come down.
So isn't it like as the feds lower the rates, obviously like mortgages, car loans, personal loans, stuff like that, even credit cards occasionally well, their rate that you're paying will go lower. But I don't know, someone was saying that then stocks usually get a boost when rates are being cut. Why is that?
Yeah. Yeah. I mean, yeah, low rates are positive for the stock market because if you can, people will assume if you can get 5, 6, 7% in bonds with way less risk than stocks, that's worth it. When the long-term average in the S&P 500 is maybe 10 or 11%, whereas if you now if rates are 3 or 4% and that's all you can get with low risk, you're maybe willing to put a little bit more money in stocks to try and get that higher rate of return that you need for a longer term financial plan. Obviously, there's always parts of a plan that are more conservative that you're happy with whatever bonds or money markets are willing to give you. But for that longer piece of the plan, when rates are low, um, people might say an investor would go more risk on in an effort to try and get a little bit better returns than what they can just get in cash or bonds.
I was going to say, just and also to somewhat back up to give a 30,000-foot view of whenever we talk about rates, what is that, and what does that even mean? And essentially, we have the Fed, and it's called the FFR, or the Fed funds rate. And essentially, what that is the Fed is trying to balance the economy. They're essentially saying, okay, if the economy sucks and is in the tank, they're going to lower interest rates, because the thought is that's going to spur on spending, like you were just talking about, Myles. If rates are lower, that means mortgages are lower, so the cost of borrowing is lower, so people are going to spend money, because not only can they borrow for cheaper, but they're also not making as much to hold on to their cash. Now, what we experienced in 2022 was the opposite of that, where the economy was hot, kind of too hot. So the Fed was trying to slow things down a bit. They wanted people to stop spending as much money. Not only did we have inflation that was kind of out of control, but the economy was just hot. So that's when they go and they raise interest rates. Therefore, people stop spending as much money because the cost of borrowing is higher and they get paid for holding onto their cash. Now, all of a sudden, instead of making a penny a year on their savings account, they can make 3, 4. It ended up being above 5% in a savings account. So that's what the Fed is trying to balance. They have two main priorities, and it's the unemployment rate that they're focused on and the inflation rate. So unemployment's been great. It's been extremely healthy ever since it got back down after COVID. It's just inflation that they've been battling. Their soft target is 2% inflation. It's never going to be completely zero, but their soft target's 2%, and it's been around like 2.5, 2.8, 2.9, somewhere in that range. They haven't quite got it down. So that's why we have a Fed funds rate that, what is it now, like 3.75 or 4%?
Yeah, I think it's around 3.75 or 4. And I was going to say that just feels like a job I don't envy. I mean, just as big as the U.S. economy is, even thinking about doing that just sounds like it can be an impossible job.
Well,
Exactly.
one thing that I mean, so some people may not understand if the Fed's fund, if the Fed, it's hard to say, if the Fed funds rate, yeah, is what'd you say it is?
Like 3.75 to 4. They put it within inside of a range.
Why are like mortgages and stuff still like a good bit higher than that?
That's a great question too. So the Fed funds rate, it's what a lot of interest rates are based off of, but also it's technically an overnight lending rate. And what that means is banks in the United States, they have to keep a certain amount of capital in reserves. And like, for example, how banking institutions work, you deposit your $1,000 into the bank. Well, the bank's just going to turn around and loan that out to somebody who needs money, but they can't loan out all 1,000, because then if you want your $1,000, all of a sudden that's where you end up with a run on the bank, and where the bank doesn't have the money to give you out. So the government has mandated that banking institutions have certain reserves to meet the demands of depositors whenever they want to pull their money back out of the bank,
which they call capital reserves, capital requirements.
Yep. Right. So sometimes day to day that changes drastically, and in order to make sure on a daily basis banks are meeting their reserve requirements, they will borrow from one another, essentially. So JP Morgan might be a little bit short, but Wells Fargo has a little bit excess, so they borrow from one another. That rate at which they borrow from one another is this overnight lending rate, aka the Fed funds rate. So that is essentially how this is initially impacting the economy, but it's a short-term rate, and it's what a lot of short-term, because this is overnight. I mean, that's as short-term as it can possibly get. Now, you think of a 30-year mortgage, that's not short-term. That's a long-term interest rate. However, it's still softly correlated to an overnight rate. So the impact is not in tandem, the Fed funds rate and the 30-year mortgage rate, but they do generally move in line with one another over longer periods of time. So just because the Fed lowers rates 1 month doesn't mean that the mortgages are immediately going to start falling, because there's also some other interest rates to look at. Is the government, or the US government, issues debt. So they'll issue 10-year bonds, 3-year bonds, 20-year, 30-year bonds. So you've got to match the length of debt along with the instrument with which you're borrowing. So for example, an auto loan that's 5 years is going to be heavily tied to what the interest rate of a 5-year US bond is, what interest rate that is, or a 30-year.
And typically, the rates on the shorter term bonds are less because there's less risk there. You're going to get your money back a little bit sooner. Whereas if you're thinking of like a 30-year mortgage, that's 30 years until if you hold it that long, that's 30 years until you're going to get fully paid on that. So you're just wanting to be paid a little bit more because of the time horizon with that. But I think like the average mortgage lasts like 7 years or something like that. Or maybe that's just because rates were really low and everybody was refinancing. But I think the average mortgage rate is like much lower because people buy houses, they sell houses. they refinance or whatever, or pull equity out, whatever it might be. And so it's very rare that anybody actually holds. I mean, maybe several years ago, and I feel like people weren't moving as much. You would just kind of hold it for 30 years or pay it off early. But now I think the typical mortgage rate is actually pretty low. But it's all still tied to what the expectation will be when they initially give you that mortgage, that you're going to have it for 30 years, and they just want to be
Really
compensated.
though, like when the Fed lowers rates, I mean, the big benefit, well, in addition to that stocks like can get a boost and stuff, but it's really like for borrowing purposes, is that's why people care so much, right?
That's right. The direct impact is borrowing purposes, because like auto loans are based off that interest rate. So auto loans, you'll see a direct impact. Banks, like personal loans, you'll see a direct impact. Um, Business loans, you'll see a direct impact. But also on the other side, the savings side, you immediately see a negative impact on your savings account rate. So not only are they lowering interest rates for whenever the banks are issuing loans to people, which can be a good thing, but they're also going to lower the interest rate to what they're paying depositors in their savings account. I love how we're just getting
You've already
into
seen that
how
come
bonds
down a
work.
little bit, right?
Yeah, and I
Yeah.
mean it happens quick. It's like as soon as they
Mhm.
cut rates, or I feel like sometimes in just anticipation of them cutting rates, they start to already lower it on people. And then you
Yeah.
have
Kind of
some,
like
yeah, yeah,
It's kind of like gas prices. It's like as soon as there's a chance to raise gas prices, oh, they're going to raise them. But are they going to lower them immediately? Absolutely not.
Yeah,
They're just going
right.
to work their way down slowly.
Yeah, so I mean, people who are all like excited about getting like 4% on their money markets and stuff, I mean, as the rates go down, that's just going to keep going down too, right?
yeah, and that's where, as people potentially work more of that cash into the stock market, you then see stock prices go up. But I think right now there's like $7 trillion plus sitting in money markets or cash on the sidelines. I mean, it's been at growing record amounts for the past several years. Um, so that's, one thing people think, that some of that money probably starts to find its way into the market as rates come down, or people maybe use that to buy a house, which is also good for the economy and kind of like spurs things along in general. So, um, lots of cash on the sidelines, and what happens with that as rates come down, I think, is to be determined.
Yeah. One thing I've never understood is how in the world do credit cards get away with charging the interest rates they charge? Like they're up into like the 30%.
Yeah, I know there was some legislation where they were trying to cap that at, I forget what the rate was. It was maybe like 10-ish%, like 7, 10%. I mean, I think
That would really help people, I
yeah,
think.
it would help
Like,
people a lot. I think at the end of the day, it kind of comes down to, it's like a contract. It'd be like if I was going to lend somebody money and they really needed it, and I was like, okay, it's going to be 30% if you want this cash,
right.
and
I know.
they have no other option. I mean, with credit cards,
That's
it's a little
right.
different, but it's kind of like just a contract. It's like if somebody's willing to sign it, that's where
Yeah.
it's at. But it does feel a
That
little
just
bit,
doesn't
and
feel
they're
right.
not meant to
Yeah.
carry balances on. I mean, it
Right.
happens from time to time with people. Um, and so, yeah, it's just like, it's, if you agree to it, that's just kind of where you're at. But it does feel a little bit not morally correct. I
Yeah.
mean, it's almost like overnight loans from like a loan, whatever, like the loan
Yeah, like a
banks, or
loan
like
shark. Yeah.
yeah, where it's like those places, it's like 30% plus. I
Yeah.
think they're even
No,
higher
it's
than
Oh,
just
that.
I'm pretty sure
ridiculous.
those are like 90% for title loans and overnight loans, stuff like that. It's highway robbery. I was trying to pull up a chart of the Fed funds rate, but we'll flash it on the screen. But just essentially to understand where we were and how over the past, like, ever since the financial crisis, I mean, we were at a point where we had 0% interest rates from 2008 all the way up until 2017, 2018, when the Fed finally started raising interest rates. And then 2020 happened, COVID. So you had back to zero on interest rates. And then they finally figured out that inflation's going to get out of control with the amount of spending and all the government spending that's happened. Then they had to jack interest rates up in 2022, all the way up. I mean, the fastest rate hiking cycle in history went from zero all the way up to 5.25, 5.5%. So now we've went from this super easy economic cycle post 2008, 2009 to kind of a restrictive cycle. And it kind of might be the new normal. And I think for a lot of people out there, I feel like with mortgages at one point, it was marry the house, update the rate, here we are 3 years later into this hiking cycle, and mortgage rates aren't 3-4% anymore. I feel like we've seen snippets of maybe high fives, but I think the days of 2 or 3% mortgages are long gone, unless something very bad happens in the economy.
Yeah, I think you've seen too. The other way I've heard that put is like nobody buys a house for what the house actually costs. They buy it for what they can afford for a monthly payment each month. And things are more expensive, but I agree with you, Carson. I think we're more in a normal area right now, like where rates should be than where they were at this time last year, or where they were during COVID times in 2021, 2022. Like the Fed shoots for around that 3% target. So we're a little bit elevated from there right now, but we're on our way down to like what feels normal. And I would agree with if mortgage rates are back at 2.5%, 3%, like we've had some clients lock in for a 30-year term, there's also more things structurally wrong in the economy that also aren't great that you don't want to see necessarily also. So I think it's kind of like we're working our way back to more normal economic levels of interest rates and where things should be. And people just have forgotten that rates have been as low as they have been since essentially 2008. And people forget, and you got to kind of get back to what's normal. And it's an adjustment period.
Yeah, I mean, I think it is like I think you're right. I think that is more normal. It feels more normal for like young people to be buying a 400, $500,000 house, not $1 million or more house because the rates are 2% and they can like afford more house. I don't know. You're right. It felt like out of whack. I am one of the people that has the 2.75 interest rate locked in 30 years, but I yeah, I don't know where we'd go if it's like I don't know, it'd be tough to go from that to like a 5.5% or something.
I mean, average mortgage rate right now is 6.3% for a 30-year mortgage. And again, just to paint the picture, the long-term average dating back to the, let's see, 70s, early 70s, 7.7% is the average mortgage rate we've had over the past 55 years. So
Which is
I know
crazy though, because like in the 80s, weren't they at like 15%?
No, I
Yeah.
remember my parents having a 13%.
In the early
That's
80s, the
crazy.
average 30-year mortgage rate was almost 19%.
That's
Now,
yeah.
you
I
were
mean,
buying a
who was
40
buying houses?
I mean, you were buying a $40,000 house, but it
Exactly.
relative, inflation and prices back then.
Yeah.
But I mean, it just goes to show that the interest rate environment that we've been in since 2008 was not normal post financial crisis, post a housing crisis where they needed people to start buying homes. Not normal. And it's just recency bias. We're all so used to seeing, 3% mortgage and how cheap it can be to buy $1 million house, and your mortgage is only $3,000 as opposed to $8,000 a month because the interest rate is more realistic. So I think it's just a hard pill to swallow for the economy, honestly.
And I think it's harder too when you're in a city like like in Nashville, where like it really felt like the boom to like the extreme end of where real estate. I feel like this has turned into a real estate podcast, but like
Yeah,
where real estate prices went, that it makes it that much harder. Whereas if you're in just like more of a rural community where, I mean, houses are still a little bit more normally priced and it doesn't affect you as much. But then like it all ties into the economy, like incomes are probably a little bit lower there and all of that comes with that also. So it all probably kind of evens itself out in the wash to some extent.
I think that's for the most part. That's pretty much everything on rates, big impacts that we see on mortgages, auto loans, savings, credit cards, and the impact that we're going to see. And really, I think setting an expectation. I think the expectation now is that the Fed may only cut 2 or 3 more 25 basis points, so 0.25% cuts, and then it might be done. So we might have this, the Fed funds rate, if we're at 3.75, 4% right now, or 4 to 4.25, whichever range that we're at right now. Their long-term rate, we might only get down to 3%. So your savings accounts might stay at 3% long-term. Your auto loans might stay around 5 or 6%. They're not going to get, stupid low like they were back in 2020, 2021. And that might be the long-term spot that we're at to keep inflation under control and keep the government spending in check. But TBD on that.
Yeah, I mean, I'll be curious to kind of see where things end up. I think if anything, it's people just need to get a little bit more used to elevated rates from what they've felt the last 5, 10, really 15 years, I guess you could say, back to 2008, 2009. And just more of a normal rate environment. And it's going to take some adjustment with where we're at. But I think we're kind of in that normal spot of where things will be. I think they'll come down slightly with a couple more cuts here. And I think you'll see mortgages come down slightly, but I don't think mortgages will be back at 3% anytime soon.
That's right.
So
unfortunately.
Or
Good deal.
fortunately.
Fortunately, my kids may never buy a house.
Definitely makes it harder. Well, thanks for joining us for another episode of the Retire While You Work podcast. It's been a good one, and we'll see you next week.
Any opinions are those of myself and not necessarily those of Raymond James. Expressions of opinion are as of this date and are subject to change without notice. The information contained in these podcasts do not purport to be a complete description of the securities market or developments referred to in this material. The information has been obtained from sources considered to be reliable, but we do not guarantee that the foregoing material is accurate or complete. Every investor's situation is unique, and you should consider your investment goals, risk tolerance, and time horizon before making any investment. Prior to making an investment decision, please consult with your financial advisor about your individual situation. Any hypothetical examples are for illustration purposes only. Actual investor results will vary. Raymond James does not provide legal or tax services. Please discuss these matters with the appropriate professional.